Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about LIAONING Port Co. Limited Annual Report. LIAONING Port Co. Limited provides a wide range of businesses and services through its 7 segments. The company offers cargo handling, transportation, port operations, and logistics services in China and internationally. In the oil products segment, LIAONING Port Co. Limited engages in oil and liquid chemical product loading and unloading, storage and transshipment, as well as port management business. The container terminal segment provides container loading and unloading, terminal leasing, various container logistics businesses, and property sales, along with wholesale activities. The company also offers bulk cargo handling services, including the loading and unloading of ore, grain, and groceries, as well as related logistics services. Additionally, LIAONING Port Co. Limited provides passenger and grocery ro-ro services, tally, tugboat, transport, power supply, information technology technical, supervision, and construction services. Furthermore, the company offers transfer and warehousing, refined oil storage, loading and unloading vehicles, and related logistics services. In terms of value-added services, LIAONING Port Co. Limited provides property management, network system maintenance, software development, supply chain management, maintenance of production facilities and equipment, information service, computer system, real estate development, and tourism development. Lastly, the company offers communications and related engineering services, making it a comprehensive provider of port-related businesses and services in China and internationally. LIAONING Port Co. Limited maintains a market capitalization of $40 billion, broadly in line with the industry peer group. LIAONING Port Co. Limited trades at a higher price-to-earnings ratio of 14 times and a lower price-to-book ratio of 0.63 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced. Investors should evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap? The balance sheet appears very conservative, with liabilities representing only 27% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The company have a dividend yield of 3.45%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various segments within an organization. On the growth side, key contributors include higher crude oil warehousing revenue, stable operation of new trade routes, and development of incremental businesses such as intraport transfers and ad hoc shipping calls. Additionally, increases in business volume of Hagia automobile and throughput in the steel segment have also contributed to revenue growth. In contrast, revenue decline drivers are more pronounced, with a significant decrease in revenue from other operations and leasing services. The container segment has seen a decline in business volume of China-Europe train lines and shipping revenue due to optimization of business structure. Furthermore, decreases in total vehicles handled, business volume of ore, and throughput of ro-ro vehicles have also contributed to the decline in revenue. The value-added services segment has also experienced a decline in income from railways, information services, engineering, and pilotage. These factors highlight the importance of diversifying revenue streams and adapting to changes in market conditions to maintain growth and stability. The net income of the company experienced a significant increase, with a growth rate of 21.45%. This upward trend continued in subsequent periods, with an increase of Rm 162,816,764.61, 14.2%, and Rm 192,220,846.39, 2.6% year-on-year. The profit margins also showed improvement, with the operating profit margin increasing by 2.89 percentage points and the net profit margin rising by 3.05 percentage points. The gross profit margin witnessed a notable increase of 7.1 percentage points to 28.6%. This growth was observed in various periods, including a year-on-year increase of 39.2 percentage points and 9.3 percentage points. However, there was also a decrease of 2.5 percentage points year-on-year. The gross profit margin for the bulk grain segment saw an impressive rise of 8.6 percentage points, from 15.9% to 24.5%. These changes in net income and profit margins can be attributed to various factors, including improved operational efficiency, increased revenue, and strategic business decisions made by the company. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. According to the latest data, the company has achieved positive operating cash flow, marking a crucial milestone in its financial health. This achievement is reflected in the substantial net cash inflows from operating activities, amounting to RMB 5,678,072,884.72. This figure signifies that the company's business activities are generating sufficient cash to cover its operational expenses and investments, resulting in a positive cash flow. The company's financial performance varied across different segments and regions. In terms of well-performing segments, the container terminal and related logistics services stood out with a revenue of $3,644,840 and an operating profit of $1,171,470. Similarly, passenger and roll-on/roll-off terminal and related logistics services also performed well with a revenue of $3,640,219 and an operating profit of $517,394. On the other hand, some segments struggled to meet expectations. The bulk grain terminal and related logistics services generated only $183,141 in revenue and $8,962 in operating profit, while the automobile terminal and related logistics services had a meager revenue of $66,923 and an operating profit of $18,620. In terms of regional performance, Bohai Rim, Hebei, and Shandong regions performed well, although specific financial data was not provided. In contrast, Northeast China region struggled due to lower total output and weak economic growth. Management is prioritizing cash flow management and debt reduction as key objectives for the company. This focus on financial stability suggests that the company is taking proactive steps to mitigate potential risks and ensure long-term sustainability. In terms of growth, the company has achieved stable production and business operations due to its competitive advantages. However, management acknowledges that it will face challenges from global economic transformation and weak market demand. Despite these external pressures, the company's strong foundation provides a solid base for future growth. Management is also considering a proposed profit distribution plan, which includes a cash dividend of RMB 0.286 per 10 shares held, subject to approval by the company's general meeting. This suggests that management is committed to returning value to shareholders while maintaining a cautious approach to financial planning. The company's financial records indicate a clear history of paying out dividends to its shareholders. On page 13, it is noted that the company has received or is owed dividends in previous years, as evidenced by the presence of dividends receivable in the accounts. Furthermore, on page 25, it explicitly states dividends, yes, confirming that the company has indeed paid out cash dividends to its shareholders. This suggests a consistent practice of returning value to investors through dividend payments. That concludes the financial summary for Liaoning Port Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.